For years, since 1994, they've said take 4% of your money and you'll never run out of money because the market gives you 7%, right? Okay, then 2001 happened. Then 2008 happened. And then they said, well, maybe 2.8% and you'll never run out of money. So this week I'm looking through financial news and U.S. News and World Report says, you can take 5% and you'll be fine. What?
Yeah. Well, that's based on the last 10 years. And if retirement was just the last 10 years and we knew the last 10 years were going to go straight up in the market, great, take out 5%. But it is the most idiotic formula I have ever heard of. I mean, for people to read these articles and go, okay, that makes sense, I'm going to do that without breaking it down for their particular portfolios, for their particular needs, for their expected life expectancy, is crazy. Mm-hmm. I mean, so let me throw it out there. I believe we're headed for a 50% correction in the market. Whoa. Period. End of conversation. I don't know when exactly this is going to happen, but it's going to happen. Mm-hmm. We're up over 330%, I think, since the bottom of 2009. So when I throw 50% out there and people are like, he's crazy, that's never going to happen, you'd still be up over 100% since the bottom of 2009 in March.
Wow.
So, folks, get it through your head. Now, let's say I'm wrong, and that never happens, and the market just corrects by 10% here and 15% there, and it immediately rebounds like it did at the end of last year. You're still in a very violent market. And, you know, I've done some studies on it. There have been 4 major flash crashes or corrections since 2010 in the last, 9 years.
Well, I remember the market going down 1,000 points in one day.
That was May 6th of 2010. The Dow Jones loses over 1,000 points before partially recovering. Mm-hmm. That was over 9%. On May 2nd through October 4th of 2011, the S&P lost 21.5%. In August 18th through the 21st, that's 3 days, of 2015, the Dow lost 1,300 points, wiping out approximately $10 trillion from the global market since June 3rd. That's a big number, $10 trillion bucks. And as we know, last year, between the high on September 20th through Christmas Eve of 2018, that was last year, the S&P 500 lost almost 20%, 19.7%. We're walking around thinking that 50% correction in the market can't happen, but we can see a 3-month period of time where we lose 20%. That's how violent and unpredictable these markets are. And when you've been going up for over 10 years, it goes up on an escalator and it comes down on an elevator. Do not have your money at risk right now without knowing your game plan and knowing how much it could correct if we lose 50% in this market.
And these rules about pulling 4%, 5%, or 2.8% or whatever it is, it implies that you have a pile of money and you're just going to pull money out of your money and there's no guaranteed money. It's not a plan.
No.
It's just not a strategy. It's just I'm going to go along with this formula, and this is a great way to run out of money.
Yeah, a better formula would be you need to generate 4 to 5% income from your portfolio. Mm-hmm. Build a moat around it, build protection around it to where you keep your principal and that money goes to work for you. I mean, we work 30 plus years to get to retirement. You've amassed this wealth. This wealth needs to pay you back. It needs to go to work. When your head is on the pillow at night, your money needs to be working for you. It needs to be generating income. So if this article or these crazy formulas would say you should be generating at least 4% income, and that's a relatively conservative portfolio mix based on where interest rates are and what other guaranteed income sources you can get. But if you can get 4% from your investable assets plus your Social Security, and then if you have a pension, you can add in on that. That's a conversation that I could actually get around, and that's a formula that I think we could work with. But to just have this, we're dependent on market growth for the next 30 years, and we're just going to use the last 10-year average, is completely, I think it's It's criminal. I'll just call it out there.
Right there.
It's criminal. And if we see a 50% correction in the market, they're going to go, oops, sorry, the 5% doesn't apply anymore. And that doesn't do you any good if you're buying into that formula.